I am Dave Springsteen, and I have been Withum's tax leader for the last 35 years. I am also the global tax leader for HLB, a top 10 worldwide network of tax advisors. Withum is a forward-thinking, technology-driven firm that helps our clients be in a position of strength in today's complex business environment. We are a go-to full-service firm in the U.S. Withum's Tax Services offers a place to discuss tax savings opportunities that are tailored to meet your goals and your objectives. Whether you're local, global, or nationwide, we're here to help. I'm very fortunate today to be with Mike Hurwitz, a CPA, MST, and is a partner in our Withum Real Estate Group. He provides tax services from coast to coast, and Mike is going to share some great insight, experience on today's topic, REITs. So, Mike, are you ready to talk about REITs?
Oh, Dave, thanks for having me. Yeah, I'm really excited to talk about REITs. I've been in the industry for many years and really focus on REITs.
Okay, so what is a REIT? Help me out here.
Well, a REIT is a real estate investment trust. That's what the REIT stands for, real estate investment trust. And they're basically companies that outright own and finance income-producing real estate across a broad range of property sectors. They might own hotels, shopping centers, data facilities, even now marinas. Marinas are considered REITs. We could talk about that. REITs are generally, there's three types of REITs out there. Equity REITs that might own just commercial buildings, hard assets. There are mortgage REITs that are like financing REITs that own mortgages that lend and are secured by real estate. And then there's what they call hybrid REITs, a little bit of both. I will say one more thing, Dave. Some of the REITs out there are public. There's a whole bunch of publicly traded REITs, 280 of them or so, even more. Some of the larger ones are in the fiber net telecommunication industry. You might know of them. And then there's a whole bunch of other REITs that are private REITs. And that's kind of where we focus. We do as a firm, as you know, a couple public REITs, but we predominantly do a lot of private REITs.
So the tax code out there, we love practicing in this arena. What are some of the benefits, the key benefits, not just from a business aspect, from a tax aspect too, of a REIT?
You know, benefits, pros and cons, depending who we're talking about. You know, clearly the public REITs, there's benefits for guys, high net worth individuals like yourself that invest in REITs, transparency, corporate governance, diversification, liquidity, being able to buy and sell in the open market. But I think the questions we're talking about more, the benefits for maybe our client base, some of the investors out there, landlords out there. A REIT, by definition, organizationally is formed as a corporation. And corporations are usually double taxed. A REIT is a special type of a corporation in that it doesn't pay tax. As long as it distributes its income out in the form of a dividend, they don't pay tax. They get what they call a dividends paid deduction. And that is a pretty big benefit for that type of an entity. And the benefits I see for our client base, taxpayers out there, investors listening in, is that it really converts income from getting a partnership K1, filing in all those states, wherever the properties are located, having passive income, and it goes into the REIT and it comes out as portfolio income, as dividend income. So it allows individuals to kind of participate in investing, the benefits of investing in real estate, Dave, but the ease of reporting through dividend income. I also see and do a lot of time structuring, by the way, with our clients. I think one of the biggest benefits for REITs is the ability to attract new capital in the capital stack. So instead of having just high net worth individuals in, now you can cater to potentially foreigners, some of the sovereign wealth funds, some of the exempt institutions, because those types of foreigners, exempts, partners, those types of partners love portfolio dividend income that comes out of the REIT. They won't be taxed on UBT, unrelated business income for the exempts, or foreigners having to file tax returns if they own directly through a partnership. So in some of the structures, maybe we could post up one of our simple structures. A REIT usually comes into the entity org structure above a partnership. You might have a partnership that owns the properties through some single member LLCs, and then the REIT will be a partner in the partnership, whereby maybe some of your foreigners are in there, some of your exempt partners, and then some of your individuals that don't want to deal with the day-to-day uh, 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 activities of operating a property. The other benefit is REIT dividends. You get the deduction, the 199A deduction. So there are quite a few benefits.
All right. So you're seeing a growth in this area of clients, prospective clients looking at REITs and actually executing on transactions.
Yeah, I've seen a big uptick. The capital stack, the need for money, the growth as some of the family offices transition from the older patriarchs down to the younger guys. The ability to attract new money is big. I think the 199A deduction is big. Being able to get dividend income. Yeah, I spend, as you know, most of my day advising and dealing
Yeah.
with private REITs. Yes.
Good. Help me with the technical requirements. You've touched on a few,
Yeah.
but what is the reporting? What are the planning ideas and the technical responsibilities of an advisor and a potential client with a REIT?
So there's a little bit of compliance, right? It's an extra entity in your org chart. So instead of just doing a partnership return and issuing K1s, now you have a REIT that you have to file a little corporate return and then send out 1099 dividends to the shareholders. But that's just the cost of doing business. One return is not all that much. But in order to get that single layer of tax and pay out dividends to the shareholders, and that's big to have a corporation having one layer of tax. It's like a mutual fund of real estate assets, no different than owning a stock portfolio where the REIT only pays one layer of tax. You have to what they call operate in a compliant manner, a REIT compliant manner. And the basic tests deal with what type of assets you own, basically if they own real estate or mortgages secured by real estate. 75% of your assets have to be good real estate assets. You have to have certain types of income, passive income from rental of occupancy, rental of space. So you have to have rental income or interest income from mortgages secured by real estate. There's a 75%, a 95% test. And then you have that distribution requirement that I had mentioned. You have to distribute out 90% of your income. Most of the time, REITs distribute out well in excess of 100% of their taxable income. And that's because they have a ton of cash. They have a lot of depreciation, which is a non-cash item. And a REIT, in its simplistic form, it's very straightforward. They collect rent, they pay their expenses, and they send the cash out to the shareholders in the form of a dividend. So they make distributions to the shareholders, this steady stream of income. And one of the requirements is you have to make distributions or else the REIT is taxed. So asset, income, distribution. There's a couple other record keeping and there's some organizational requirements, but those are easily passed, Dave. And the asset tests are quarterly and the income is annual.
Sure. It sounds like the REITs are more simplified in the reporting than a partnership that's in the real estate arena with all the detail the IRS wants in a K1 and supplement to the K1s. Seems like a great alternative.
In the couple on that, a lot of the senior investors that are looking to get away from the day-to-day management of it, they'll contribute their properties into the OP, eventually convert it to REIT stock maybe, and then they just pick up dividend income. So yeah, it's much easier. You're just picking up dividend income opposed to filing in all the states, and yeah, I agree with you.
Okay. Boil it down for me. Who should be looking at the REITs? Those that have raw land, those that are currently in a commercial rental structure, residential properties. What do you call?
I think everyone, Dave. I go to seminars, I go to conventions, I'll talk to anyone about anything. Again, a REIT is any type of real estate, whether it's raw land, hotel, data center, office building, marinas, billboards. These are all deemed real estate. If you have taxpayers looking to raise capital I think this is a great avenue because, again, it opens doors to foreigners. It opens doors to the exempt partners, high net worth individuals that don't want to file in all the states. They just want a steady stream of dividend income. I think it's a great entity, business entity, and I think anyone that's going out and buying real estate should at least have a conversation with it. Is there a need or a place for a REIT to be in there?
Sure. So as we wrap up today's discussion, Mike, I appreciate your insight. I'm sure this is
Thank you.
just the tip of the iceberg, but the real estate industry has been afforded many, many tax incentives, and those that are playing in this market should also consider REITs. But from that space, I would think that you need to stay tuned because Mike will be hosting and speaking at other real estate incentive podcasts.
You're so nice, David. Thank you.
Provide more value to your decision process. So again, Mike, thank you for your time.
Thanks for listening, guys.